So this is one of Tavi's charts that he's shown in the past, and Tavi's going to have a pre-recorded presentation because he's in the mountains and his internet connection's a little spotty. We'll see. We got him on here too, but we'll have a pre-recorded session. And this chart didn't make it into his session, and so I'm like, well, heck, I want to show it, so I'm showing it here. And this is and look, Bitcoin has been coming down the past few weeks, and look at how it's diverging from the NASDAQ. This is one of these technically correlated kind of indicators. People think that that Bitcoin is an alternative to gold. We don't share that same view. In fact, gold and silver have been up recently as Bitcoin's been coming down. That's much more pleasing to us to see. But this is an indication of this Bitcoin kind of being a lead indicator, perhaps, for a bigger fall in the frothy, overvalued mega cap tech and NASDAQ names, showing this divergence here. Let's go on to the next. Now I've shown this chart the past few weeks, and we have a whole letter, building off of this. And so I'm just going to go through it quickly again. NVIDIA recently reached 11.7 times GDP in terms of enterprise value to GDP. This compares to Cisco at its market peak at the peak of the tech bubble in 2000, more than twice as richly valued compared to the overall market. And it comes in at 41 times sales. Cisco was 30-something times sales at the peak of the tech bubble. Let's keep going here. I don't want to waste a lot of time. But of course, I've shown this too. And look, this tech bubble just keeps getting bigger. It is insane. The top 10 mega cap tech stocks today, because of this AI euphoria, represent 60%, more than 60% of GDP now. This has gone to a new high, higher than that late 21 top, more than twice as high as the tech bubble peak when those top 10 stocks reached about 30% of GDP in aggregate. And the valuations are just stretched across the board. People will let's go on to the next. People will say, oh, but the fundamentals are still strong. Let me just hop in here and talk about this Sun Microsystems chart. So Scott McNealy in 2002, after the tech bust in the early 2000s, he basically wrote a letter to shareholders saying, what were you people thinking buying my stock at 10 times revenues? And he said 10 times revenues, to give you a 10-year payback, I would have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. It assumes I pay no taxes, which is very hard. And that assumes that you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero R&D for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64 a share? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? Of course, this was after the stock had totally crashed. Some of you might remember that Sun Microsystems was one of the biggest positions that I built among my client base back in 1998, and along with Qualcomm, and they were two of the leaders back in the tech bubble. We'd sell half every time the thing doubled, and I got out too early in both of those stocks, but I didn't completely get out until March of 2000, and then I got all my clients out except I was still a broker back then in March of 2000, and we had just launched our first strategy, the large cap portfolio as well. But I was also a broker, and so I was a position builder type broker, and so I build positions and stocks among the brokerage clients, and these are my two largest positions. So calling all the clients, getting everyone out, finally, after we'd already sold half and half and half every time the thing doubled in March of 2000, because it was ridiculous. A couple of clients didn't want to get out, of course, and that was their problem. But so after the fact, Scott McNeely is saying, what the heck were you guys thinking? This was a 10 times revenues a computer company. Look, we have NVIDIA at 41 times revenues today. Anyway, let's go on to the next. This is a chart that Nathaniel did, just showing how valuations, the combination of price to earnings, price to cash flow, price to sales, price to book in aggregate, on average, are as high as they've ever been, as high as the 2000 top, as high as that 2021 top. And here we are again. And people will say, well, the fundamentals are really good right now. The growth rates, the margins of these mega cap tech stocks that are driving this overall S&P valuation. But look, if the valuations are really that, if the fundamentals are really that strong, we should be calling into question the sustainability of those things. If profit margins are historically high, if looking at trailing growth rates, those things are still really high. We really got to question, are we at a peak inflection in the economic cycle? And if so, we should be putting a low multiple on those things, not a historically high multiple. And that's the same lesson that Scott McNeely was trying to say after the fact. And so we just, this is extraordinary risk. We have an extraordinary frothy market today. It's something to watch out for. Let's keep going. Rising inflation expectations. So this is in our letter, and again, I've shown this chart before, but the Fed is losing control of long-term inflation expectations, and we have to be cognizant of what that means, because inflation expectations are a self-fulfilling force, and the Fed has been trying to keep them anchored. You hear it say all the time, we believe that long-term inflation expectations are well anchored. Well, does this look like well anchored when you look at the Michigan survey of consumers and their 5 to 10 year inflation expectations? At the mean, it's up to 5.6% over the next 5 to 10 years. This is what coming unanchored looks like. And now let's go on to the next. If we look at the distribution of these expectations, you can see that it's the bottom third of households based on household income that has the highest inflation expectations, up close to 7%. And these are the people that are hurt the most by rising inflation. But then the middle income, and then the top 1/3 of household incomes has the relatively lowest inflation expectations, but they're still rising. You can see, but this is the group that's responsible for the allocation in the securities markets, and this is the group that is still historically underweighted to inflation in terms of their investment positioning, underweighted to commodities in particular, underweighted to gold, and this is the setup that we see for the rotation of these folks into these out of the overvalued segments of the markets and into the undervalued commodities. Still ahead. Let's keep going. This is one of Atavi's charts that we show in the letter. We have the trade. He probably showed this chart in his presentation, so I'm not going to dwell on it too much. But we have twin deficits. The trade balance report, which just came out, showing the trade balance declining again due to rising imports and rising import prices. Let's go on to the next. But it's not just the trade balance. We have a twin deficit, a current account deficit and a fiscal deficit. And combined, the current account deficit and fiscal deficit are now more than 10%. This is the level that we saw going into the global financial crisis. Of course, during the COVID pandemic, it got even worse. And we're supposed to be in an economic expansion, and yet we're running 10%, a 10% twin deficit. This is highly, highly inflationary, and people are not positioned for the inflationary consequences of what this means. Let's keep going. Time to build a mine. One of the biggest imbalances that we see is the imbalances in the commodity markets due to the underinvestment in commodities for the, really for the last really since 2010. It's been like a 13 since 2011 at least. It's been a 13-year bear market period for capital investment in mining and exploration and building new mines. The world needs this stuff. The world needs metals if we're going to have this new modern economy with the EVs and the green energy economy and all this fiscal spending going into this, all this deficit spending. We need metals. We don't have the metals. It takes 16 years to build a mine, and we haven't had that capital investment for the last 14 years. Let's keep going. Part-time employment for economic reasons. So this is a chart that Nathaniel put together here, and it's showing that when you see rising part-time employment for economic reasons, that's when people are being forced to go back to work and to take on a second job to afford the cost of living. When do you normally see this? Historically, when has this always started to rise? It has always started to rise at the beginning of a recession. And of course, it's inflation, that it's the cost of living that is forcing people to take on these second jobs. And this is this is something that the markets still don't have a handle on. I mean, the Fed has everyone fooled that inflation is going to be under control. At least everyone responsible for allocating, portfolio investments. But the broad population is not fooled. They know that inflation is out of control already right now, and this is one of the catalysts for the recession. Let's keep going. Similarly, when the unemployment rate crosses above the 24-month moving average, you might say, oh, it's just a little blip. And of course, we had the unemployment numbers, surprising, a little bit higher unemployment again with the data that came out this morning. And what is this? It's a signal ahead of every recession. So let's keep going here. So, Tavi's shown this chart before. I'm just going to show it again. There's, family offices only allocate 1% of their portfolios to commodities. We believe we are at the beginning of a new secular bull market for commodities. We see a rotation coming out of overvalued mega cap tech. This AI, AI is wonderful. The advancements in AI are highly disruptive, however, and we believe that we are going to see creative destruction. That's what the letter is all about. It's about creative destruction. It's a term coined by Joseph Schumpeter, who was a Austrian economist. I was just in Vienna on vacation last week, and we learned about the Austrian economists, and they creative destruction is real. It's the economy can only support so much overall market share for the existing incumbent entrenched monopoly technology companies. But the AI is a new disruptive force. If you have any doubt about it, just go look at Perplexity. Start using their internet search engine. It's an LLM based AI search engine, and they are going after Google's business model and monopoly on search. No advertising at all, but just a well summarized, with links to the web pages and summaries of those web pages. No ads. and super fast. This is a VC funded. It's still a private company, but the monopoly oriented mega cap tech companies, and their excessive market share and valuations. This is not something that can be sustained if we're going to have overall real economic growth and real progress from a new technology like the advancements in AI to grow the overall real economy GDP pool. There needs to be disruption of the incumbent monopoly based companies. And so I think people are just making a huge mistake in the valuations that are being attributed to the mega cap tech stocks today. It is exactly like the internet bubble. People will say, no, it's nothing like the internet bubble. BS. It's exactly like the internet bubble. And there's a lot of unwinding here to go. So, look, we're very bullish on commodities. We see a great rotation out of the mega cap tech and the overvalued financial assets and into undervalued commodities. We see a new commodity bull market ahead, and that's how we're positioned.